Hello everybody, it's Tortoise Investing coming at you today with another 5 dividend stocks that you can buy and hold forever. I feel today that we've got some great ones that are on sale and that are great compounders. I tried to pick ones that are 2% or more dividend yield, so you're going to be able to see that compounding take effect a little bit quicker. Very quick, if you are new, please hit that subscribe button and join the 374 that have already done so, and make sure to hit that like button and comment down below. It helps with the algorithm a lot and it makes me super happy. Let's keep growing this thing. Now without further ado, let's go ahead and jump into it. If you came for just what they are, today we're going to be taking a look at General Dynamics, Keurig Dr Pepper, Abbvie, Alexandria Real Estates, and Next Era Energy. Now, if you came just for those, thanks for dropping by. Now, if you want a quick deep dive into them, let's go ahead and take a look. General Dynamics, this is a defense stock. This is one that I've got my eyes on because it has dropped here as of recently. It's got a free cash flow yield of 4.9%, a dividend yield of 2.57%, and a payout ratio of 41%. So everything falling just in line in all those sweet spots that you like to see. On the year, General Dynamics is down 15.2%. Let's take a look at the 1 year chart. Yeah, it looks like it hit the 250 range, a little bit above 250, hovering around 210 now. So I do feel like that is on sale. If you take a look here, they do have free cash flow that is growing, and you like to see it. Their revenue is slowly growing, not too much though. And since 2020, their EPS looks like it is ticking in the right direction. Again, although slowly, it is growing. They do have some debt at $7 billion, but their EBITDA is $5 billion. This is absolutely no issue whatsoever. Their debt is not a problem. The dividend has been growing at a rate of 7.26% over the last 5 years, so a nice little compounder. And they've been doing some share buybacks slowly but surely, and they have a return on capital employed of above 11.5%. So it is a defense stock. The whole budget plan, all that went through and got approved. The White House isn't going to touch their defense budget, so that is completely safe, and I feel like this is a strong moated company as well. You got General Dynamics, you got Northcom, I believe, and Lockheed Martin. You got the great three when it comes to your defense stocks. Now we got Keurig Dr Pepper coming in here at a free cash flow yield of 4.06%. It's got a dividend yield of 2.57%, payout ratio a little high, 83%, but I think that's going to be completely fine. A lot of these soda companies, Pepsi, Coca-Cola, they generally have a higher payout ratio in the high 60s to 70s area, and sometimes they do tip the 80s when times are hard. Now, Dr. Pepper is down 12.57%. The thing that I really like about it are their financial sheets here. Over the last 5 years, revenue's been growing at 16%. The free cash flow is growing at a rate of 24%. Very nice. And their EPS was growing. It looks like they had the 2022 hiccup. A lot of companies had an issue because last year was technically a recession. Probably going through one right now as well. But Keurig Dr Pepper, if you look it up over the last 10 years with like dividends reinvested and stuff, it's beating S&P 500, and I like that. I like that a lot. The dividend right here has been increasing at a rate of, let's see here. This throws it off because they had the stock split. I think they're growing at around 7% or so. Yeah, it looks like it because it went from 15 to 19 to 20. So, I like it. I think it's a great compounder. The Dr. Pepper's got a lot of good things under their wing. Again, the great three. Like I said with the defense stock a while ago, with this you got Dr. Pepper, Pepsi, and Coca-Cola. Yeah, I like this a lot. I think that this is a great holding, and it's down. I feel like this is a great buy-in opportunity. Coca-Cola and Pepsi aren't really down. They've been where they've been for a bit, so I think that this might be a good opportunity. Abbvie, I love Abbvie. I got Abbvie in my portfolio. Has adjusted free cash flow yield of 9.56%, dividend yield of 4.44%. It is down 16.6% on the year. That revenue is growing at a rate of 15.5%. The free cash flow is growing at a rate of 20.7%. EPS ticking in the right direction, 14.8% over the last 5 years. They do have some debt at $59 billion, but with $19 billion EBITDA, it's not 3 times more than their debt. Their debt is not more than 3 times their EBITDA. And if you look here, their debt is going down. The debt's decreasing while the free cash flow is increasing. Like to see that. Dividend's been increasing at a rate of 9% over the last 5 years. And the return on capital employed is increasing. So yeah, when it comes to healthcare stocks, I really, really, really like Abbvie. I'm planning on trying to add a little bit more, especially since it dropped a little bit. The payout ratio is 53%. It is not 136%. But yeah, I just want to go ahead and have that pulled up because I've showed it off a time or two. Again, I think it's a great sale. Not financial advice, just personal opinion. Next up, Alexander Real Estate. I think REITs are going to have an absolutely amazing time over the next year or two. This one has a free cash flow yield of 6.68%. It has a dividend yield of 4.31%. Currently down almost 18% on the year. It's actually down a little bit more because it touched 170. Now it's down to 118. Take a look at revenue. Revenue's grown at a rate of 18% over the last 5 years. Free cash flow yield's been growing very rapidly. They were in a negative for a while, but it looks like 2019 they figured things out, and it has just been going up and to the right ever since. The dividend has been increasing at a rate of around 6% over the last 5 years. And yeah, I've got the FFO here. Their FFO consensus estimate was $2.15 a share. They came in at $2.19, so it beat expectations. And last year was $2.05. So it is growing. Like to see it. And their FFO payout ratio is very low at 55% for the last 3 months. So that is another thing that you really like to see. A strong REIT that is on sale in my eyes. And winding things down, we got NextEra Energy, the only utility that I would ever have and trust. It's like the utility of the future. Fully renewable energy. They got a dividend yield of 2.59%. Payout ratio of 51.7%. Free cash flow yield. Like almost all of your utilities have negative free cash flow and they've got growing debt. That's just how they work. It's how they operate. On the year, it is down 12.47%. The revenue has slowly been increasing at a rate of 4% average over the last 5 years. The EBITDA is growing and the net income is there. Like I said, when it comes to these are a little tricky because they live and die by debt. Their dividend has been increasing at a rate of 11% over the last 5 years. They've came out and stated that they plan on to keep it in the high to around 10%, 8 to 10% going forward. So I like that. I like that a lot. And a big thing with these, with honestly all of these, most of these are recession resistant. I won't say proof. I don't know of any real recession proof stock, but utilities, REITs, healthcare, consumer, defense, these are all great ones for a possible recession that may be on the horizon. But yeah, that's everything I got for you. Hope you enjoy. Make sure to hit that like and subscribe button for more goodies to come. And until then, see you.